In the summer of 1602, something extraordinary happened in Amsterdam. The citizens of the Dutch Republic were invited to participate in a commercial adventure unlike anything the world had ever seen. For the first time in history, anyone could buy a share in a company. You didn't need to be a nobleman, a banker, or a friend of the king. A shopkeeper, a widow, an artisan. Anyone could invest. The company was called the Verenigde Oost-Indische Company. The Dutch East India Company. VOC, by its Dutch initials. When the subscription closed on the 31st of August, 1602, 1,143 people had invested. It was the first initial public offering of shares in history. And those shares began to be bought and sold between individuals. First in coffeehouses. Then on a bridge. Then in a building the city constructed expressly for this purpose in 1611. The stock exchange had been born. And with it, one of the most transformative forces of the modern world. In the previous episodes we've explored how markets for goods and services work. Supply and demand. Prices. Elasticity. Competition and monopoly. But there are markets where you buy neither apples nor shoes. You buy and sell something much more abstract, partial ownership of companies. A piece of a business. The right to share in its profits and its losses. Today we'll discover how the stock market was born, why it exists, and how it works. From the spice ships of the 17th century to the algorithmic screens of the 21st. To understand why shares were invented, you need to understand the problem they solved. In the 16th century, trade with Asia was the most lucrative business in the world. Spices, pepper, cinnamon, nutmeg, cloves were worth a fortune in Europe. A single ship that returned loaded with spices could multiply the investment fivefold or tenfold. But the risk was enormous. The voyage lasted 1 to 2 years. Ships could sink in storms, be captured by pirates, lose their crew to disease. Roughly 1 in 3 ships didn't come back. If a merchant financed a ship with his own money and that ship sank, he lost everything. It was an all-or-nothing bet. The solution was to spread the risk. Instead of one investor financing a ship, many investors each put in a small amount. If the ship sank, each lost a little instead of everything. If it returned, they all shared the profits. This wasn't new. Venetian merchants had been doing it since the Middle Ages with commendas. What was new about the VOC was the scale and the permanence. Commercial companies before the VOC were formed for a single voyage. Capital was gathered, the ship was sent, profits were distributed upon return, and the company was dissolved. The VOC was different. It had a 21-year charter granted by the Dutch government. It was a permanent company. Capital wasn't returned after each voyage. It stayed invested in the company. But this created a problem. If you'd invested and needed your money before the company distributed profits, what did you do? The answer was to sell your share to someone else. And for that, you needed a place where buyers and sellers could meet. That's how the secondary market for shares was born. VOC shares began changing hands between investors. The price rose when news was good, a ship returned loaded with spices, and fell when it was bad. In 1611, the city of Amsterdam commissioned Hendrik de Keyser to build a structure dedicated exclusively to commerce. There, shares of the VOC, the West India Company, and all manner of commercial contracts were traded. It was the world's first stock exchange. The idea spread quickly. In London, share trading began in the coffeehouses of Exchange Alley in the 1690s. Jonathan's Coffee House became the center of operations. Traders sat with their cups of coffee and negotiated shares in companies, government debt, and marine insurance contracts. In 1773, London stockbrokers formalized their association and moved into their own building. The London Stock Exchange was born. On the other side of the Atlantic, on the 26th of May, 1792, 24 stockbrokers gathered under a buttonwood tree on Wall Street in New York and signed the Buttonwood Agreement. They committed to trading securities only among themselves and to charging a fixed minimum commission. It was the origin of the New York Stock Exchange. The street where the agreement was signed, Wall Street, would become synonymous with global finance. Stripped of all the financial jargon, a share is something very simple. It's a piece of ownership. If a company has 1 million shares and you hold 1,000, you own 0.1% of that company. Of its factories, its offices, its profits. And also of its debts and its problems. Being a shareholder gives you 2 things. First, the right to receive a portion of the profits the company distributes, called a dividend. Not all companies pay dividends. Many prefer to reinvest profits to grow. Second, the right to vote on the company's important decisions. Electing the board of directors. Approving mergers. Deciding on executive compensation. In practice, small shareholders rarely exercise this right. Real power lies with large funds and institutional investors. And why does a share's price go up or down? For the same reason the price of anything goes up or down: supply and demand. If many investors want to buy a company's shares and few want to sell, the price rises. If many want to sell and few want to buy, the price falls. What drives the supply and demand for shares are expectations about the company's future. If investors believe a company will make more money in the future, they want to buy its shares today. If they believe it will make less, they want to sell. That's why news moves markets. A good quarterly result pushes the price up. A scandal sends it crashing. A technological innovation propels one company and sinks its competitors. When a company decides to start selling its shares to the public for the first time, it carries out an initial public offering, known as an IPO. It's a crucial moment. The company obtains fresh capital it can use to expand, invest, and hire. In return, it cedes part of its ownership to strangers. From that moment on, it must publish its financial results, submit to audits, and answer to thousands or millions of shareholders. Going public is, in a sense, democratizing ownership. Anyone with an investment account can buy a small piece of the world's largest companies. A retired teacher in Valladolid can be a co-owner of Apple, Toyota, or Nestle. But it also has a less bright side. Market pressure forces companies to think short-term. If this quarter's results miss expectations, the price drops, executives are questioned, employees may be laid off. The tyranny of the quarter can conflict with decisions that would benefit the company in the long run. When you hear on the news that the market went up or down, they're not talking about all stocks. They're talking about an index. A stock market index is a basket of representative shares that serves as a market thermometer. The IBEX 35 groups the 35 largest companies in Spain. The Dow Jones includes 30 large American companies. The S&P 500 covers 500. If the index rises, companies are generally earning more, the economy is growing, confidence is high. If it falls, expectations are deteriorating. But an index is an average. It can rise even while many companies are in trouble, simply because a few giants drag it upward. The index doesn't tell you the whole story. Just a summary. For centuries, the stock exchange ran on the human voice. Brokers crowded the trading floor, shouted orders, chalked prices on boards. It was chaotic, noisy, human. Today, more than 80% of trades on the world's major exchanges are executed by computer algorithms. Programs that analyze data, detect patterns, and execute orders in milliseconds. It's called high-frequency trading, and it has completely transformed how markets operate. Orders that once took minutes now execute in microseconds. Prices adjust instantly to each new piece of information. Efficiency has increased enormously. But new risks have also emerged. In May of 2010, the flash crash caused the US market to lose and recover nearly $1 trillion in a matter of minutes. One algorithm triggered a chain of automatic sales that fed on themselves until other algorithms reversed the trend. The market had become so fast that humans couldn't follow it. Machines were trading with each other at speeds no human brain could process. The stock market has a complicated relationship with society. On one hand, it has been one of the great engines of modern prosperity. It allows companies to raise capital to innovate, grow, and create jobs. It allows savers to participate in economic growth. The pension funds of millions of workers are invested in the stock market. On the other hand, the stock market amplifies inequality. In most countries, stock ownership is enormously concentrated. The richest 10% own the vast majority of market assets. When the market rises, the rich get richer. When it falls, workers' pension funds lose value. And there's a growing disconnect between the stock market and the real economy. Markets can soar while unemployment rises, as happened in 2020 during the pandemic. Corporate profits can break records while real wages stagnate. The stock market is an extraordinary tool for mobilizing capital. But the distribution of its benefits remains one of the great unresolved questions in economics. 3 ideas to take away from this episode. First, the stock market was born to solve a practical problem: spreading the risk of long-distance trade. The Dutch VOC in 1602 was the first company with publicly traded shares, and Amsterdam was the world's first stock exchange. Second, a share is partial ownership of a company. Its price rises and falls based on investor expectations about future profits. Stock market indices summarize market behavior, but they're averages that hide many details. Third, markets have shifted from open outcry trading to algorithmic trading. Speed and efficiency have increased, but new systemic risks have also emerged. Shares let you own a piece of a company. But the financial world has invented markets for almost everything: government debt, barrels of oil, wheat harvests, and even bets on what the market will do tomorrow. In the next episode, we'll enter the world of bonds, commodities, and derivatives. Instruments born to reduce risk that have sometimes multiplied it to the point of catastrophe. That's next time.